Okay, so it's Wednesday, January 21st, 2026. And I want to start by asking you to just think back. Think back to your portfolio statement from maybe, 2 months ago?
Oh, boy.
Yeah. If you are holding any significant crypto exposure in, say, November, December of 2025, you probably felt this very specific kind of nausea.
Okay.
We're talking about a 30% drawdown. I mean, Bitcoin had just tagged that all-time high on $125,000 in October, and then almost overnight, the floor just fell out.
It was a bloodbath.
Yeah.
I mean, there's really no other way to describe that fourth quarter. If you were just looking at the charts, it looked like a classic cycle ender, the big one.
Right. And in any previous cycle, you think about 2018 or 2022, that would have been the signal for everyone to pack it up, sell the bottom, and just go home for 4 years.
The crypto winter.
Exactly. But, and this is really the reason we're doing this deep dive today, that didn't happen. The price crashed, absolutely. But the infrastructure, it didn't even flinch. We're looking at data now that shows institutional inflows, the big money. It stayed net positive even while the candles on the chart were just screaming bright red.
And that, right there, that's the signal we need to isolate. We are so far beyond talking about retail speculation anymore. We're not talking about a digital gold rush or, gambling on dog coins.
Right.
We are looking at a market where actual federal legislation, specifically the Genius Act, and these major institutional ETFs have fundamentally integrated what we're calling the crypto economy straight into the standard American 401k landscape. It's messy, it's incredibly volatile, but it is officially, it's infrastructure.
So welcome to the deep dive. We are stripping away all the hype today. We are not going to talk about which token is going to the moon.
Nope.
We're talking about the plumbing, the actual plumbing of this, as you said, mature crypto economy. We are looking at how a serious U.S. investor actually allocates capital to this space in 2026.
And to do that, you have to get into the weeds. I mean, really into the weeds. So we've pulled together a pretty heavy stack of research for this one. We've got the index methodology documents from VettaFi and Alerian. We've got the prospectus and the fact sheets for the Invesco SATO ETF specifically. And then we've got some very dense but very revealing strategic analysis reports from Galaxy Digital that cover the whole 2025 to 2026 market outlook.
Okay, so let's start with the basics, because I feel like the terminology itself has kind of shifted under our feet. We keep using this phrase, crypto economy.
Right.
And I think for, 90% of people, even savvy investors, that's just a synonym for buying Bitcoin or maybe Ethereum.
Yeah, buying the coin.
But the sources we're analyzing today, especially those Alerian Galaxy documents, they draw a very, very sharp line in the sand.
They do. And it's a distinction that completely defines your risk profile. I mean, it's everything. When Alerian and Galaxy talk about the crypto economy, they're referring specifically to the equity side of the ecosystem.
Like the stock.
The stocks. Exactly. We are not talking about digital bearer assets held in a hardware wallet somewhere. We are talking about publicly traded companies, with tickers listed on the NASDAQ or the SIBO.
So not just a random basket of tech companies that mention blockchain once in an earnings call.
No, not at all. That's the old way. The index methodology is actually really rigorous. It breaks this economy down into 4 very distinct pillars. And if you want to understand what you're actually buying in a fund like SATO, you have to understand these 4 buckets.
Okay, lay them out for us.
So first you have the miners.
The ones securing the network, verifying transactions.
Right, but it's broader than that. It's also the companies building the specialized chips, the ones engineering the cooling systems, the whole mining supply chain. Then second, you have the buyers.
Okay.
This is a category that has just exploded in the last, say, 3 years. These are corporations, publicly traded companies that are strategically accumulating crypto right on their balance sheets.
So this is the MicroStrategy model, but now it's being adopted by a much wider net of companies.
Exactly. It's no longer just 1 or 2.
Yeah.
So let's call them eccentric CEOs. It's becoming a legitimate corporate treasury strategy for some firms.
Interesting. Okay, what's number 3?
Third, you have the enablers. This is the classic picks and shovels category.
Right.
The exchanges, like Coinbase, custody banks, payment rails, the hardware and software that makes everything else work.
The plumbing.
The plumbing, exactly.
Yeah.
And then finally, and this is the one that I think confuses people the most, you have a category called investment vehicles.
Yeah, this one stuck out to me in the methodology doc. The index itself tracks other trusts and ETPs. That seems circular.
It does seem circular,
Yeah.
and we're definitely going to touch on why that's structurally necessary later on. It involves the Cayman Islands, of all things.
Of course it does.
But for now, Just think of it as including things like private investment trusts or other exchange-traded products that hold the tokens directly. It's basically a way for an equity index to get price exposure to the underlying commodity, to the coin, but within an equity wrapper.
Okay, so we have these 4 pillars: miners, buyers, enablers, and these investment vehicles. But here's the question I think a listener is probably screaming right now. If I think Bitcoin is going to $200,000, why don't I just buy Bitcoin?
Sure.
Why would I mess around with an equity index that just tracks companies associated with Bitcoin? Isn't that just diluting the trade?
It's a fantastic question. And it comes down to what kind of beta, what kind of risk you actually want in your portfolio. To answer it, we have to compare the index we're talking about. That's the Alerian Galaxy Crypto Index, ticker CRYPTO, against something different, like the Bloomberg Galaxy Crypto Index or BGCI.
And the BGCI, that one tracks the coins themselves.
Exactly. The BGCI tracks the bought price of Bitcoin, Ethereum, Solana, and so on. It moves purely on the supply and demand of the coin. It's a pure commodity risk.
Got it.
The COPTO index, the one SAO follows, tracks the businesses. And in a risk-off environment, and we saw this play out perfectly during that government shutdown scare last year, crypto equities behave much more like high beta technology stocks.
Meaning they're influenced by things like interest rates, earnings reports, all that traditional finance stuff.
All of it. They have corporate guidance, they have cash flows, or at least, they're supposed to.
Right. Bitcoin does not have an earnings call.
Bitcoin does not have an earnings call. It doesn't pay a dividend. Miners and exchanges do. So when you buy this equity index, you are fundamentally betting on the growth of the industry's infrastructure, not just on currency adoption.
So it's the difference between hoarding gold bars in your basement versus buying shares of a gold mining company like Newmont.
That is the perfect analogy. They're highly correlated, absolutely. When gold goes up, Newmont stock probably does too.
Yeah.
But they are fundamentally different assets with very different tax treatments. And crucially, very different risk profiles.
Okay, let's talk about the architects here for a minute. You mentioned VettaFi and Galaxy Digital. This partnership seems to be really central to the legitimacy of this whole product.
It's a marriage of necessity, really. On one side, you have VettaFi, which owns Alerian. These are the quants. These are the index construction nerds.
Yeah.
They build indices for a living, energy infrastructure, MLPs, very complex regulated things. They bring the math, they bring the pipes, they ensure the rebalancing happens according to a rigid set of rules so that the SEC stays happy.
And Galaxy Digital brings the street cred.
It's more than just cred. I'd say they bring the operational reality. I mean, we're talking about Mike Novogratz's firm here. And if you look at the corporate profile on our source stack, Galaxy isn't just some asset manager sitting in a Manhattan tower guessing what Bitcoin is doing.
No, they're vertically integrated. I was reading through their operational scope, and it is just massive. They run an investment bank, they do asset management, but they mine Bitcoin themselves.
That's the key differentiator. That is what separates them. I loved this one detail from their 2025 recruitment drive that was in the report. They were hiring protocol engineers and master electricians at the same time.
That sounds like the setup to a joke.
It sounds funny, but just think for a second about what that implies. You need protocol engineers to understand the code updates, the forks, the consensus mechanisms, the digital side.
Right.
But you need master electricians because you are running gigawatts of power through these massive, hot, noisy data centers. They are physically building the network.
So they have that dirt under the fingernails expertise.
Exactly. And that expertise feeds directly back into the index construction.
Yeah.
When they're deciding which miners to include in the CRYPTO index, they're not just looking at market cap. They know who actually has the power contracts secured and who is just, issuing fluff press releases.
So they've got the map, which is the index. Now let's talk about the vehicle itself. For a U.S. investor, how do you actually buy this thing? And that brings us to the Invesco Alerian Galaxy Crypto Economy ETF. Ticker is SATO.
A little nod to Satoshi Nakamoto, of course.
Of course. So it's listed on the CBOE BZX. Expense ratio is 0.60%, 60 basis points. That's fairly standard for a thematic ETF, I'd say.
Yeah.
But I want to stop here and really, really dig into the prospectus, because there is a structural component in here that I think most people just gloss right over, but it tells this huge story about the U.S. regulatory environment.
You're looking at the subsidiary.
I am looking at the subsidiary. Page 14, it says, and I'm quoting here, the fund may invest up to 25% of its total assets in a wholly owned subsidiary organized under the laws of the Cayman Islands. Now, look, usually when I see Cayman Islands in a financial document, my brain immediately goes to tax dodge.
And that's the natural reaction.
Yeah.
But in this case, it's not a tax dodge in the evasion sense. It's more like a survival mechanism.
Yeah.
This is where this maturity era we're talking about meets the very messy, very old reality of the 1940 Act.
The Investment Company Act of 1940, the rule book for all mutual funds and ETFs.
That's the one. And to be a compliant ETF under the 1940 Act, you generally need to be what's called a regulated investment company, or RIC.
Okay.
And to maintain that RIC status, you have these incredibly strict rules about where your income comes from. Specifically, 90% of your gross income has to be what the IRS calls good income.
Good income. What does that mean?
It means income from securities, stocks, bonds, currencies, things like that.
And the IRS does not view Bitcoin as a security.
There you go. The IRS views Bitcoin as property or a commodity. So if an ETF held Bitcoin directly or even Bitcoin futures directly and then sold it for a profit, the IRS might classify that profit as bad income.
Bad income. This sounds very biblical.
It does. And if you have too much bad income, you lose your tax advantage RIC status as a fund. The whole ETF structure could basically just collapse under its own weight.
So the Cayman Fund is what? A filter, a laundry service.
But blocker. It's a clever piece of financial engineering. SATO takes up to 25% of its assets and invests them in this separate company, this Cayman subsidiary.
Right.
That Cayman entity then goes out into the market and buys the investment vehicles, the futures, the trusts, the stuff that generates that bad income.
And then what happens to the profit from that stuff?
The Cayman Fund pays a dividend back to the U.S. parent fund, back to SATO. And miraculously, the IRS treats a dividend received from a controlled foreign subsidiary as good income.
Wow.
It effectively washes the commodity taint off the money, so it fits perfectly into a clean SEC-compliant wrapper that you can buy in your Schwab account.
That is incredible financial gymnastics, just to let people buy a basket of stocks and some crypto exposure.
It is. But it's actually standard practice for a lot of commodity funds.
Yeah.
Gold funds, oil funds, they often use very similar structures.
Yeah.
But for you, the listener, the big takeaway is that SATO isn't just buying stocks. As of early this year, 2026, roughly 16.85% of that portfolio is sitting in this Cayman vehicle.
So it's a significant chunk.
It is. And it's what allows the ETF to give you that pure price exposure to the asset itself without breaking a bunch of 70-year-old securities laws.
Okay, so that handles the structure, but now we have to talk about the tax bill for the actual investor, because this is where I think a lot of people get hurt if they're not paying very close attention.
Oh, absolutely. This is critical.
I was looking at the distribution history for SATO. In December 2025 alone, just last month, the fund paid out nearly 96 cents per share.
Which is a massive number relative to its share price. I mean, huge.
Right. The forward yield listed on some brokerage websites in January 2026 is showing something like 19%. Now, if I'm a retiree looking for income and I see a 19% yield, I'm thinking, I have found the Holy Grail.
And you would be walking straight into a tax trap. This is so crucial for our audience to understand. Do not mistake this yield for corporate profit. This is not Coca-Cola paying you a dividend from selling soda.
So what is it?
It's a capital gains distribution.
Okay, explain the difference for someone managing their portfolio.
It all comes down to the turnover. The CRPTO index, the one SATO tracks, rebalances monthly.
That is extremely frequent for an index.
It's hyperactive. And in a sector as volatile as crypto, you might have a minor stock that doubles in price in like 3 winks. The index rules, the math, just says you are overweight, sell it.
So the fund manager is forced to sell the winner.
Right. And when you sell a winner, you realize a capital gain. Because SATO is a regulated fund, it must pass those realized gains on to its shareholders by the end of the year.
So that 96 cents I received in December, that was the fund basically just handing me my own money back, but now it comes with a tax liability attached.
Precisely. You got it. So if you're holding this fund in a standard taxable brokerage account,
you're getting a 1099 form in the mail.
And you are owing taxes on that 19% yield, even if the share price of the ETF itself actually went down over the year.
That is just painful. A painful lesson in fund mechanics.
It's a high-yield instrument, yes, but that yield is a byproduct of volatility and asset churning. It is incredibly inefficient from a tax perspective. If you are going to hold this, you really, really want to be doing it inside a tax-sheltered account like an IRA or a 401k, where those distributions aren't a taxable event.
That is exactly the kind of nuance that the to-the-moon crowd on social media usually misses. Okay, let's shift gears and actually look inside the portfolio itself. We know about the 17-odd% in the Cayman Fund. But looking at the top equity holdings for January 2026, we see some familiar names. Bakkt, Metaplanet, and then a whole lot of miners. Bitdeer, Hut 8, Riot, Iron.
And that miner composition is where the real story is right now. It's the most interesting part of the fund.
The Galaxy reports from 2025 refer to this as the pivot, and frankly, reading about it, it sounds like a survival strategy that was born out of the last crypto winter.
It started as a survival strategy, but it quickly became a growth strategy. The dominant narrative of late 2025 and coming into 2026 is this convergence, this unexpected marriage of crypto mining and artificial intelligence.
Right. We've all seen the headlines about miners rebranding themselves as high-performance computing or HPC centers. The question is this real, or is it just, marketing hype to pump the stock price?
No, it is very real. And it's driven by basic physics. Just think about what a Bitcoin miner actually owns. They don't really own Bitcoin. What they own is land, massive electrical transformers, and incredibly sophisticated cooling infrastructure that's capable of dissipating the heat from thousands of screaming hot machines running 24/7.
Which is exactly the same infrastructure you need to run large AI models.
Precisely. The biggest bottleneck for the AI boom right now isn't just getting enough NVIDIA chips. It's finding a place to plug them all in that won't, melt or black out the grid. So companies in the index like Iron and Applied Digital, they started this pivot. They're taking a portion of their data center capacity and literally swapping out their Bitcoin ASICs for high-end NVIDIA GPUs.
But economically, from an investor standpoint, why does that matter so much? I mean, revenue is revenue.
No, not at all. The quality of the revenue is fundamentally different. Think about it. Bitcoin mining revenue it's stochastic. It's random.
It depends on the price, the difficulty.
The global hash rate, your own luck.
Yeah.
It's wildly volatile and unpredictable.
Okay.
AI compute revenue. That is a fixed lease. You sign a multi-year contract with a hyperscaler, a Microsoft, or an Amazon or a Google for a fixed rate per month. It turns the miner from a wildcatter into a digital landlord.
So it completely stabilizes their cash flow. It gives them a predictable baseline.
It acts as a massive hedge. It's a game changer. When Bitcoin plummeted 30% in the fourth quarter of 2025, the pure play miners who had no other revenue source got absolutely hammered. Their stocks fell off a cliff.
But the ones who had pivoted.
But the miners that had successfully pivoted to HPC, they had a floor under them. They had this guaranteed contracted revenue coming in the door, regardless of what the crypto market was doing.
So by holding an ETF like SATO, you're not just holding a levered bet on the price of Bitcoin anymore. You are effectively holding a hybrid digital infrastructure play. It's part crypto casino, part data center REIT.
That is the maturity era in action. The asset class is diversifying its own revenue streams from within. It just completely changes the risk profile of the entire sector.
Okay, since we keep mentioning that crash, we have to address the elephant in the room. We're painting this kind of rosy picture of infrastructure and AI pivots, but the last 3 months of 2025 were just a brutal roller coaster.
A roller coaster that made a lot of people very, very sick.
So walk us through it based on the reports. October 2025, we hit the all-time high, $125,000 for Bitcoin. Pure euphoria in the market.
And then
Just darkness. The notes we have from Galaxy mention a government shutdown as a major catalyst. Connect those dots for me. How does that work?
it all comes down to information. Or in this case, a lack of information. We had that 43-day partial government shutdown in November and December. It was the longest in U.S. history. And the crucial part for markets is that it closed the data taps. The Bureau of Labor Statistics, the Bureau of Economic Analysis, they just stopped publishing their reports.
So no CPI numbers, no jobs reports, no inflation data.
Nothing. The market was flying completely blind. And when institutional trading algorithms are flying blind, what's the one thing they are programmed to do?
De-risk.
They de-risk. They sell the asset with the highest historical volatility first, no questions asked. And that is always, always crypto.
So a lack of centralized government data caused a massive sell-off in decentralized assets. The irony is just, it's thick.
It is, but it shows you how deeply integrated these markets are now. But, it wasn't just the macro picture. The Galaxy reports also highlight massive profit-taking from long-term holders. You had whales who had ridden that wave all the way up to 125K, and they were systematically distributing coins to new retail investors.
Selling into the hype.
Always. And then December hit.
And that means tax loss harvesting.
Aggressive harvesting. Because the price had already dropped so much in November, it created this perfect opportunity for investors to sell, lock in those losses to offset gains they had elsewhere in their portfolio. It just created this self-reinforcing selling spiral into the end of the year.
But, and this brings us right back to our opening point, the core thesis of this whole conversation, Despite the shutdown, despite the 30% price drop, despite the whale selling and the tax harvesting, the institutional money didn't actually leave the room.
This is the institutional resilience argument, and it's the most bullish part of the whole story.
Right.
If you look at the fund flows for SATO and the broader ETF ecosystem, net inflows for the full year remained at a positive $22 billion.
Incredible.
In 2018 or 2022, a drop like that would have completely drained the liquidity from the system. Retail would have capitulated, everyone would have run for the exits.
But this time was different.
This time, the capital is sticky. It's institutional capital. It's in 401k models. It's in pension fund allocations. You don't panic sell your entire retirement account because of one bad month. The investor base has fundamentally upgraded from a nervous speculator to a strategic allocator.
And that strategic allocator is now operating in a completely new legal environment. I mean, here we are in 2026. The Trump administration is back in the White House. But maybe more importantly for this space, we have actual laws on the books now.
The regulatory thaw is the other massive pillar of this recovery. We absolutely have to talk about the Genius Act.
The Guiding and Establishing National Innovation for U.S. Stablecoins Act, passed in July of 2025, it is a mouthful.
It is a terrible acronym for a truly historic piece of legislation. Before the Genius Act, U.S. banks were terrified of touching crypto. There was this one specific SEC accounting rule, SAB 121, that basically said if a bank held crypto assets for a client, they also had to hold $1 of their own cash on their balance sheet to back it.
Which made the whole business of custody prohibitively expensive. It was a non-starter.
It effectively banned regulated banks from participating in the sector. The Genius Act, along with the repeal of those restrictive accounting bulletins, completely changed the math. It created a federal framework and a charter for stablecoins. But more importantly, it allowed qualified, regulated banks to act as custodians without completely destroying their balance sheets.
So now you have a State Street or a BNY Mellon or these massive legacy trusted financial institutions theoretically able to hold the very assets that an ETF like SATO is tracking.
Exactly. It's the final piece of the puzzle. It paves the way for what Galaxy's reports call Project Crypto, which is really the tokenization of all traditional securities. The long-term idea that eventually stocks and bonds and real estate will all live on these blockchain rails. The Genius Act was the green light for the big banks to finally start building that infrastructure in earnest.
Which brings us to a bit of an obituary, a final data point here. We've talked about what's growing SATO, the AI pivot, the mining sector, but the Invesco documents we reviewed also contained a death notice.
The liquidation of BLKC.
SATO's sibling ETF, the Invesco Alerian Galaxy Blockchain Users and Decentralized Commerce ETF. Effective next month, February 2026, it's being shut down, liquidated.
And this, to me, is one of the most telling signals of market maturity that we have.
Okay, explain that. Because usually when a market is booming, you see more products launching, not fewer. Why is the death of an ETF actually a good sign?
Because BLKC was a product of a bygone era. It was a 2021 style product. It tracked blockchain users. And what that meant in practice was that the fund held stocks in companies like Walmart or FedEx or Oracle.
Wait, why?
Simply because those companies had issued a press release at some point saying they were using a private blockchain for supply chain management or something.
So if I bought BLKC, I wasn't really buying crypto exposure. I was basically just buying a very diluted, very expensive tech fund.
You were buying the S&P 500 with a marketing gimmick attached. And the investors of 2026 are just too smart for that now. They've been through a few cycles. They realized, hey, if I want exposure to Walmart, I'll just buy Walmart stock. If I want exposure to the crypto economy, I want the real thing.
So the money moved out of these diluted tourist funds and consolidated into the pure infrastructure funds like SATO.
It's a consolidation to quality, to purity. The market has decided it doesn't need blockchain as a buzzword anymore. It wants direct, measurable exposure to the actual economy of the asset class, or wants nothing at all. The death of BLKC is proof that the hype cycle is finally over and the serious allocation cycle has begun.
You know, it really feels like we're standing at this massive convergence point. For a decade, it felt like crypto and traditional finance were at war with each other. One was trying to disrupt and replace the other. But what we're describing today, with these complex Cayman subsidiaries designed to satisfy the IRS, with Bitcoin miners becoming AI data centers, with regulated banks using the Genius Act to custody stablecoins, it feels like the war is just over. And they merged.
That's the perfect synthesis.
Yeah.
The hoodie guys hired the suit guys, or maybe the suit guys just bought the hoodie guys' companies. But either way, we now have this incredibly volatile, innovative asset class that has built a serious suit and tie industrial-grade infrastructure around itself. It is no longer an experiment. It's a sector, just like the energy sector or the tech sector. And now you have the crypto economy sector.
Which leaves me with one last final thought for the listener to chew on, a provocative question. If the flagship crypto economy ETF, SAO, is pivoting its underlying companies to service the AI boom,
Right.
and if the big banks are now using stablecoins just for boring back-office settlement, and if the blockchain users ETF is dead because the technology is just becoming a ubiquitous background utility,
I see where you're going with this.
does the term crypto itself eventually just disappear? In 5 years, are we even going to have a crypto deep dive? Or is this all just going to be absorbed into tech infrastructure? Are we looking at the last few years where we even treat this as some separate exotic category at all?
You know, that is the ultimate success metric for any new technology, isn't it?
Yeah.
Yeah, it has truly won when people stop talking about it and they just start using it without thinking. We might be a lot closer to that silence than most people think.
Something to think about while you're reviewing those tax lots from December. That's it for this deep dive. Thanks for listening.
Stay curious.